So we'll start with reading number 35 of the level 3 curriculum that will take us through the CFA Institute's required and recommended global investment performance standards. Now please note, performance reporting is definitely an area of concern, and as professionals in the finance industry, we need a standard that all fund managers and all fund houses should follow to report their performance, such that comparability of the performance can be enhanced not just amongst different funds but also amongst different countries. So the CFA Institute has provided us with its own recommended and required investment performance standards that it expects investment managers and fund houses across the world to adopt so as to facilitate the comparisons that we discussed. Now, as far as the exam is concerned, for the most part, this reading will require you to memorize the different standards and the different requirements that JIPS have. However, what I would recommend is that definitely pay a lot of focus on the requirements and pay relatively lesser focus on the recommendations. So a lot of times the questions on the exam will test the requirements. And if you read the recommendations and then on the exam you forget whether this was a recommendation or it was a requirement, then it will be a problem because you will get confused as to whether it is right or wrong, because recommendations are only recommendations. So even if they are not present in the performance presentation, it is not per se a problem. So in a way, even if you ignore the recommendations and go and just read the requirements, maybe it is even better for the perspective of the exam because you won't get confused with the recommendations. So, recognizing the need for one globally accepted set of standards, CFA Institute sponsored the JIPS committee to develop and publish a simple global standard by which all firms can calculate and present performance to clients and prospective clients. So, the Board of Governors formally endorsed the JIPS on February 19, 1999. The latest edition is the 2010 JIPS standards effective January 1, 2011. So the objective is to establish global industry-wide best practices for the calculation and presentation of investment performance, facilitate the accurate and so there's some 1,000 points that we'll have to go through today together like these. So just be concentrated at that point in time. I know you'll get bored. The sooner we finish it, the better you will understand. If it gets delayed, then I'll start losing you in the middle. So be very focused, please. Facilitate the accurate and unambiguous presentation of investment performance results to current and prospective clients. Facilitate a comparison of historical performance of investment management firms. Encourage full disclosure and fair global competition without barriers to entry, and encourage self-regulation. So if you follow the JIPS standards, then yourself, if you are a good performing fund, then you will stand out. It will ensure that you be transparent and you disclose your performance. The characteristics of JIPS are that JIPS basically are voluntary minimum standards for performance presentation. If firms so want, they can disclose more than what is required by JIPS. Firms must meet all requirements on a firm-wide basis in order to claim compliance. What is a firm? We will study soon. Only investment management firms may claim compliance. These standards are only for fund management firms or investment management companies. They should provide a minimum standard where local or country-specific laws, regulation, or industry standards may not exist. JIPS require managers to include all actual fee-paying discretionary portfolios in composites defined according to similar strategy and or investment objective to be included in the performance presentation. So managers cannot cherry pick funds that have done well or portfolios that have done well. So all portfolios should be included. What is a composite? Again, we'll study. Firms must present a minimum of 5 years of JIPS compliant history or since inception if less than 5 years. After presenting at least 5 years of compliant history, the firm must add annual performance each year going forward up to 10 years at a minimum. Firms may link years of non-compliant performance but must present only compliant data for periods beginning on or after January 1, 2000. Firms must use prescribed calculation and presentation methods and include required disclosures in the presentations. What the required disclosures are, we'll study soon. Meeting the objective of full and fair disclosure will likely require more than just compliance with the minimum guidelines of GIPS. So firms think, or GIPS thinks, that actually firms should present more than what GIPS requires. To fully explain the performance included in a presentation, firms are encouraged to present all relevant supplemental information. In cases in which applicable local or country-specific laws are in conflict with GIPS, the standard requires firms to comply with the local regulation and make full disclosure about the conflict. Firms are encouraged to develop monitoring processes and controls for maintaining GIPS compliance. Firms must document the policies used to ensure the existence of ownership of client assets. January 1, 2011 is the effective date of the 2010 edition of GIPS. Presentations that include performance for the periods beginning on or after January 2011 must comply with the 2010 version of the GIPS. Scope is that firms from any country may come into compliance with GIPS. Compliance with the standards will facilitate a firm's participation in the investment management industry on a global level. For periods prior to January 1, 2006, firms are granted reciprocity, so that if pre-2006 data are presented in compliance with the previous edition of GIPS or a country version of GIPS, such data may continue to be shown as compliant with the revised GIPS as well. The benefits of existing and prospective clients derive from the ability to compare the performance of firms operating in different countries with different sets of established practices. GIPS ensure that performance data are complete and fairly presented so that existing and prospective clients can have greater confidence in the comparative investment results. GIPS compliance must be on a firm-wide basis. Total firm assets are defined as the total fair value of all assets the firm manages, including non-fee paying and non-discretionary portfolios. Also included in the definition are assets delegated to sub-advisors, as long as the firm has selected the sub-advisors. If a portfolio is deemed discretionary, it is considered sufficiently free of client-mandated constraints such as the manager is able to pursue its stated strategy, objectives, or mandate. So important, the definition of firm. That is, all assets that the firm is managing. All assets that they are managing discretionary, even if they are not fee paying. As long as you are managing them it yourselves or with your discretion, are they reflective of your performance? Yes, they are. So they all must be included. If there are significant client constraints, that is significant client mandates that are hindering discretionary performance, then you may choose to ignore that portfolio from the overall presentation because it does not reflect your own performance. A firm, very importantly, is defined as an investment firm, subsidiary, or division held out to clients or potential clients as a distinct business entity. A distinct business entity is defined as a unit, division, department, or office that is organizationally or functionally separated from other units, divisions, departments, or offices, and that retains discretion over the assets it manages, and that should have autonomy over the investment decision-making process. So the fixed income department of a fund management of a mutual fund cannot be a firm. because it is not a distinct business entity. The insurance arm, the mutual fund arm, the investment banking prop trading arm can be taken as three different business entities and three different firms, all requiring to be compliant separately with GIPS if they so choose. So compliance, however, can only be taken on a firm-wide basis. You cannot say my equity department is GIPS compliant. The whole firm has to be GIPS compliant or not. In order to claim compliance with GIPS, a firm must adhere to all the requirements laid out in the sections that follow. Furthermore, firms need to have written documentation of those policies and procedures that ensure compliance with the standards. Once a firm has met all of the required elements, the firm may use the following compliance statement to indicate that the presentation is in compliance with GIPS. So XYZ claims compliance with GIPS and has prepared and presented this report in compliance with GIPS standards. XYZ has not been independently verified. Firms cannot claim partial GIPS compliance. This specifically prohibits statements such as dash in compliance with global performance standards except for. So there is no provision for anything like this. So to prepare the performance and present the performance, we first need the returns data and the input data. So following are the GIPS input data requirements. So don't have to remember the number and name of the standard, but generally know that A is a requirement. And all standards with A you have to focus a lot of attention on. So this is what you have to remember. Standard 1B would be a recommendation. So on the B's or on the recommendations, you don't have to worry too much about. All data and information necessary to support the firm's performance presentation, including calculations, must be stored and maintained. For periods beginning on or after January 1, 2011, portfolios must be valued at fair value according to GIPS principle. Cost or book values are not permitted. We'll see what these fair value calculations are. Prior to January 1, 2001, portfolios must be valued at least quarterly. This is important. Beginning on or after January 1, 2001, they should be valued at least monthly. Beginning on or after January 1, 2010, at least monthly and on date of all large extra cash flows. We know this is important because the time weighted rate of return calculation will be good or will be done properly only if I revalue the portfolio at the date of every large external cash flow, as we did with the examples on evaluating performance. So prior to January 1, quarterly, after January 2001, monthly, after 2010, monthly, and on all large external cash flows. That's not extra cash flows, external cash flows. For periods beginning January 2010, firms must value portfolios as of calendar month end or the last business day of the month. So you can't value it whenever you like in the middle of the month, either last calendar day or last business day. For periods beginning January 1, 2005, firms must use trade date accounting, not settlement date accounting. So it is the date on which the order was given, that is the date that will be used. Accrual accounting must be used for fixed income securities and all other assets that accrue interest income. So this is the method that we studied at level 1. There should be amortization to par value. Market values of fixed income securities must include accrued income. For periods beginning January 1, 2006, composites must be consistent or must have consistent beginning and ending valuation dates. Unless the composite is reported on a non-calendar fiscal year, the beginning and ending valuation dates must be at calendar year end or on the last business day of the year. So the valuation date needs to be consistent. Most countries in the West would follow December 31st to January 1st as their financial year as well as the calendar year. In such a case, December 31st is when it needs to be valued definitely. If you're following, many countries follow March 31st to April 1st as the financial year, then standards require that March 31st the composite must be valued. Now again, these are recommendations. So generally speaking, the requirements must be memorized. Rather than only at large external cash flows, portfolios should be valued at each external cash flow, not just large. It's a recommendation. Valuations should be obtained from an independent third party. You can do it yourself also, but recommended obtained from third party. Dividends from equities should be accrued as of X dividend date. When presenting net of fees returns, firms should accrue investment management fees. So it's not just the cash fees, it is based on, again, accrual accounting. As far as the calculation of returns is concerned, first of all, total returns must be used. Time-weighted rates of return that adjust for external cash flows should be used. Periodic returns should then be geometrically linked. External cash flows must be treated in a consistent manner with the firm's documented composite specific policy in order to determine when portfolios in the composite require revaluation. At a minimum, for periods beginning January 1, 2005, firms must use approximated rates of return that adjust for daily weighted external cash flows. For beginning 2010, firms must value portfolios on the date of all large external cash flows. So, in the original dates method, that is permitted for performance of data until January 2005, wherein if you didn't revalue the portfolio at every large external cash flow, then how do we approximate or how do we adjust for that? So there was some large cash flow happened in this period. However, we didn't split it into two periods and measure the performance separately as we should have done, as we are required to do today. But for periods so much prior, what we will do is, we will approximately assume that the cash flow came in the middle of the year. So the return will be calculated as the ending value minus the beginning value minus the cash flow upon the beginning market value plus half of the cash flow. So definitely this cash flow should not be a part of the return, because this was just an additional cash that had came. So our ending market value would anyways be higher to the extent of the cash flow. So this cash should be removed. However, this cash would have made some return also. That would also be in the ending market value. Hence, in the denominator also this cash should come. But should it come for the entire period? No, we assume that the cash approximately came at the middle of the period. So if there was a large cash flow in this period, then according to the original dates method, the return would be ending value minus beginning value minus the cash flow upon the beginning value plus 0.5. Let's assume the ending market value is $100 and the beginning market value is $50. So my return was 100%. Now in this year, if I had received a cash flow of $50, that is an external cash flow of $50, then was the return 50%? The return was actually 0, because this 50 would have become 100 even if you made 0 return, just because of the cash flow. So the way the return is calculated is, first of all, you deduct the cash flow. After deducting 50, whatever is remaining is actually the return. So that fixes our numerator. However, if $50 came, then dividing it with just 50 is also incorrect, because return was not made on an investment of only 50. It was made on a higher investment. But then adding entire 50 is also not correct, because that assumes the 50 came right at the beginning of the period. So we just add half into 50, assuming it came at the middle of the period. Time-weighted rate of return methodologies that are just for daily cash flows are required for periods beginning January 2005 until January 2010. So the original Dietz method was only allowed for periods before 2005. From 2005 to 2010, we will use the modified Dietz method. Modified Dietz method is calculated as the ending value minus the beginning value minus the cash flows. The numerator remains the same. That's the correct adjustment that we did last time also. However, on the investment front, we will now actually weight the cash flow for the period it was invested. So if it's a monthly return, for instance, and the cash flow came on the 10th day, then it was invested for how many days? 20. So the weight applicable to that cash flow would be 20 by 30. If it came in the middle, the weight applicable would be 1 by 2. If it came right at the end, so whatever period it was invested in on the total period is what the weight will be for that cash flow. The modified IRR method, also called the modified Bankers Administrative Institute method. So this method calculates the return as the internal rate of return or something similar to the internal rate of return. So what we say that the return is that rate that makes the ending market value equal to the beginning market value into 1 plus R plus the incremental cash flows into 1 plus R to the power W, where W is again the weight for which that cash flow was invested. So the W is the same as this W. So for instance, if there was no external cash flow, then this return would have been the same as ending value minus beginning value divided by the beginning value. If there were cash flows that were right in the beginning, then the weight would again be 1. So this would again be ending value minus beginning value upon beginning value. If there were cash flows that were in the middle of the period, then this 1 plus R would be raised to the power that same weight. So if it was there for half the period, it would be raised to the power 1 by 2. If it was there for 3/4 of the period, a particular cash inflow, then it would be raised to the power 3 by 4. The R that makes this equation equal to the ending value is your actual rate of return that should be used for the performance presentation. For periods after January 2010, you have to do the regular time weighted rate of return calculation that we learned in evaluating portfolio performance. So the return has to be calculated at every external cash flow as the ending value minus the beginning value upon the beginning value. And then the return can be aggregated to compute the annual return or your overall return or the total period return as 1 plus R2 into 1 plus R3 into 1 plus Rn minus 1. Returns from cash and cash equivalents, that is any money market instruments, treasury bills, etc., should also be included in the total return calculation. All returns must be calculated after the deduction of actual trading expenses incurred during the period. Estimated trading expenses are not permitted. So both are very important, these points. If actual direct trading expenses cannot be identified and they cannot be segregated from a bundled fee, then when calculating gross of fees returns, returns must be reduced by the entire bundled fee or the portion of the bundled fee that includes the direct trading expenses. So you have to be over conservative. If you are unable to separate the direct trading expenses, please note, direct trading expense is the brokerage. The fund management fees is normally not a part of the direct trading expense. That is another expense, or that's fund management expense. So brokerages that are paid on any other direct cost, any direct tax that you have to pay to the government for the trade that you have done should be deducted when calculating the performance. Even when calculating the gross of fees returns, so in gross of fees, we only deduct direct trading expenses. in net of fees returns, we deduct the fund management fees also and other expenses also. So when calculating gross of fees returns, we must reduce them by the entire bundled fee if we are unable to estimate the direct trading expenses, that is, be more conservative, or the portion of the bundled fee that we know includes these direct trading expenses. At any point in time, estimated trading expenses cannot or are not permitted. When calculating net of fees returns, returns must be reduced by the entire bundled fee or the portion of the bundled fee that includes the direct trading expenses and the investment management fee as well. The use of estimating trading expenses is not permitted. So please note, even in gross of fees returns, the direct trading expenses have to be removed. Composite returns must be calculated by asset weighting the individual portfolio returns using beginning of period values or a method that reflects both beginning of period values and external cash flows. Now please note, a lot of times our portfolios are balanced portfolios, that is 50% debt, 50% equity. So a company will have various composites, or a fund management will have various composites. So there will be a 100% equity fund, or funds which are 100% equity. Then they can be mid cap, small cap, so on and so forth. But these are 100% equity. Then there would be 80% equity funds. And there would be 60% equity funds. These are also called balanced funds. So a composite is one type of asset allocation. So it may consist of two or more portfolios, a fixed income segment, an equity segment, etc. So when we said all composites of a type must be reported, so when you are reporting the performance of equity, then all equity funds or all portfolios of this type must be reported in the performance. You can't include some and not include others. So the returns must be calculated by asset weighting the individual portfolio returns using beginning of period values or a method that reflects both the beginning of period values and external cash flows. So if you have 50% equity and 50% fixed income, then the return of your composite will be calculated as 50% into the return of the equity portfolio plus 50% into the return of the fixed income portfolios. These weightages are generally the beginning of period weightages or beginning of period weightages adjusted for external cash flows. So if external cash flows came in equity, then weight of equity will go up. If external cash flows came in fixed income, then weight of fixed income will go up. The beginning market value weighted composite return can be calculated using the following formula. So this is straight up. Just do the weighted average return of all portfolios. So weight of portfolio 1 into the return from portfolio 1 plus weight of portfolio 2 into the return of portfolio 2. Weight is what? The beginning market value of this portfolio divided by the beginning market value of the total portfolio. The beginning market value plus cash flow weighted return can be calculated as follows. So the return of the portfolio will be whatever is calculated. However, the weighting mechanism will depend on the beginning market value plus how much cash flow that portfolio received weighted by how much time that cash flow was invested in the portfolio. So this weight is the same as the weight that we've been talking about up till now. So it was invested for 20 out of 30 days, then 2 by 3 into the cash flow we will do. So it will still be a similar weighted average that will be happening, but the beginning market value will change to the beginning market value plus the weighted average cash inflows, weighted by how much time they were invested in. And similarly, we'll add it to the denominator also for all composites, or rather all portfolios making the composite. So let's do a few examples and understand these concepts. Given the portfolio information in the figure below, use the modified Dietz method to calculate the rate of return for this portfolio for April, May, June and the second quarter of 2009. So April is the fourth month of the year. So we have the value on 31st March 2009 and 4th or 30th April 2009. The beginning value is 220, the ending value is 228.8. So the return will simply be 228.8 minus 220 divided by 220 for the month of April. For the month of May, again the value after the cash flow is 282.7 and that cash flow came in on 12th of March 2009. And again on 31st May 2009 the value was given to be 289,300. So if we apply the modified Dietz method, it would be the ending market value, that is 289.3, minus the beginning market value, that is 228.8, minus any cash inflow that had happened. So 44,000 of cash inflow had happened, divided by the beginning market value plus the cash inflow weighted by the time that the cash flow was invested. So it came in 12 and it was invested for 19 days. So 44 into 19 by 31 is the total beginning value of our investment. This will be the return for the month of May. For the month of June, similarly, the value was 289,300, which became 269,500. This is the calculation for May, the return. We can similarly do it for the month of June. So it will be again the ending value minus the beginning value, that is 289.3, minus any cash inflow. In this case there was a cash outflow, so this will get added. Minus of minus 33 will become plus 33, again divided by the beginning value. The beginning value was 289.3. However, we know we didn't have so much money invested for the whole period. 33,000 was not invested for the last 10 days. So multiplied by 10 divided by 30. Because 33 was only invested for 20 days. So this will give us the performance for the month of June. For calculating for the second quarter, we will have to do a time weighting. That is, it would be 1 plus the return in April into 1 plus the return in May into 1 plus the return in June minus 1. This would be the return for the second quarter of calendar year 2009. So please verify the calculations. 4%, 6.5%, 4.74%, and the second quarter return will come out to be 15.96%. Given the information in the following figure, use the daily valuation method to calculate the rate of return for this portfolio for April, May, June and the second quarter of 2009. Now, on every large external cash flow, we have to value it again. So for the return of April, it will be straightforward. There is no cash flow complication. So it will be 560 minus 550 divided by 550. For May, we'll have to split May into two periods. First 30th to 12th and then 12th to 31st. So from 30th to 12th, our return was 560 becoming basically 565. So in the first part of May, return of May 1, you can say, would be 560 minus, or rather 565 minus 560 upon 560. Return on May 2 can be written as 633 minus 620 divided by 620, because 620 was invested for the next 19 days. And then for the whole May, it would simply be return on May 1 into return on May 2 minus 1. This is the return for the entire month of May. Similarly, we can compute the return on June, or in the month of June. So we'll first compute return on June 1. That is 633 became 645. So it will be 645 minus 633 divided by 633. Similarly, return on June 2 will be calculated as 623 becoming 627. So 627 minus 623 divided by 623. And the return for the second quarter will again be 1 plus April into 1 plus May into 1 plus June minus 1. So please verify. May 1, May 2 for the whole month of May, June 1, June 2 for the whole month of June, and then 1 plus April, 1 plus May, 1 plus June minus 1. Using the data presented in portfolios A and B, calculate the composite return using the beginning market value weighted method, the beginning market value plus cash flow method, and the aggregate return method. So again, from 31st March 09 to 30th April 09, we have been given the values. So that is portfolio A. The second portfolio in this composite is portfolio B. So portfolio B has a market value of $250,000 at the beginning, and again all details have been provided for portfolio B also. So the monthly return for both portfolios is given. So for portfolio B, it is 8.26%. For portfolio A, it is 11.32%. In the beginning market value weighted method, we will simply use the beginning market value. That is 5 by 7.5 into 11.32 plus 2.5 divided by 7.5, because that was $250,000 to begin with, multiplied by 8.26. If we use the beginning market value plus cash flow method, then the total beginning market value of portfolio A will be calculated as 500 plus 100 that was invested for 20 more days into 20 by 30, which will come out to be 533.33. Similarly, the beginning market value of B will be calculated as 250 minus 35 into 12 by 30, because 35,000 was not invested for 12 days, which comes out to be 35 into 12 divided by 30 minus 250. That's $236,000. So again, the return or the composite will be calculated as 533.33 divided by 236 plus 533.33 into 11.32 plus 236 divided by 236 plus 533.33 into 8.26%. So it comes out to be 10.3%. So this will come out to be 566.66 or $566,000. Similarly, for portfolio B, it will be 250 minus 35 into 12 by 30, because for 12 months this amount has not been invested, which will become 236. So the weighted average for portfolio B would be 566.66 upon 236 plus 566.66 into 11.32 plus 236 upon 236 plus 566.66 into 8.26. So please verify the calculation. 10.3% for the beginning market value and 10.42% using the beginning market value plus cash flow method. In the aggregate return method, the two portfolios are assumed to be 1 and then the return is calculated. So portfolio A had a value of 500 and portfolio B had a value of 250. So we can say we started off with a beginning value of 750 that had become 235 at the end for portfolio 4 and it had become 665 at the end for portfolio A. So we can compute the ending market value would be 665 plus 235 minus the beginning market value of 500 plus 250 would be 750 divided by the beginning market value of 750. However, for both these portfolios, we have to make adjustment for the cash flows. So 100,000 additionally came in portfolio A and 35,000 went out of portfolio B. So we'll subtract 100 and we'll add 35. The beginning market value can't be taken to be 750 because there was more invested. $100 additionally was invested for a period of 20 out of 30 days. So plus 100 into 20 by 30, and $35 similarly was not invested for a period of 12 out of the 30 days again. So into 12 by 30. So this would be the aggregate return method. Please note it is unlikely that these calculations will come on the exam. So understanding the theory behind it and understanding the methods is more important than understanding the maths behind the questions. For periods beginning January 1, 2006, firms must calculate composite return by asset weighting the individual portfolio returns at least quarterly. For periods beginning January 2010, composite returns must be calculated by asset weighting the individual portfolio returns at least monthly. So important, 2006 to 2010 quarterly, from 2010 monthly. Again, not very important. We will go through the recommendations as well, but these are only recommendations. Returns should be calculated net of non-reclaimable withholding taxes on dividends, interests and capital gains. Reclaimable withholding taxes should be accrued. So withholding taxes are often applied by governments on assets leaving their country. If such taxes are applied, they should be reduced from the returns. All actual fee-paying discretionary portfolios must be included in at least one composite. So this is very important so as to ensure you're not cherry picking and you have actually presented the performance of all portfolios. There is no selection bias or survivorship bias in your reporting. Although non-fee paying discretionary portfolios may be included in a composite, non-discretionary portfolios must not be included in a firm's composites. We discussed this point earlier also. So whatever represents your performance must be included and must be presented. The committee defines discretion as the ability of the firm to implement its intended strategy. A client may place significant constraints on the manager. For instance, the IPS may specify limits on sectors, credit ratings, durations, etc. Furthermore, there may be total restrictions on certain transactions, such as purchase of unethical or foreign investments or of specified stocks, as the client may have mentioned in his unique circumstances. So the restrictions do not automatically remove the discretionary nature of the portfolio. That is, if you conclude that because of these factors, etc., the management of this fund is not discretionary, that is, there's too many constraints for you to pursue your independent strategy, then you may remove, or rather you have to remove that portfolio from the presentation. All discretionary portfolios need to be included. A portfolio becomes non-discretionary when the manager is no longer able to implement the intended strategy. For instance, the liquidity requirements are so great that much of the value must be in cash, or if the portfolio has minimum tracking limits from an indexed portfolio, that is, you're completely replicating the portfolio, then the description of discretionary is no longer appropriate. Composites must be defined according to similar investment objectives and/or strategies. Composites must include all portfolios that meet the composite definition. The full composite definition must be available on request. So for example, if I define a composite as 40% equity and 60% debt, then again, I can't just choose the 40% equity portfolios that performed well. All portfolios that have 40% equity and 60% debt have to be included when I'm reporting the performance of this composite. And all portfolios otherwise must be a part of at least one composite or the other. Important this point. Composites must include only assets under management within the defined firm. Firms are not permitted to link simulated or model portfolios with actual performance. Even with disclosure, you are not allowed to do that. So you can't put a note in the bottom and say the performance is simulated. Even if it is written, simulated performance is not allowed. Very common in the question for them to put a nice disclosure, but say it is a simulated performance. So if the performance is simulated, it is not allowed to be presented. A very common simulation becomes if you have, let's say, 3 months return or a 1 quarter return, and then for presenting you are annualizing it. That is not allowed. You cannot do that. Composites must include new portfolios on a timely and consistent basis after the portfolio comes under management. Terminated portfolios must be included in the historical returns of the appropriate composites up to the last full measurement period that the portfolio was under management. Portfolios must not be switched from one composite to the other unless documented changes in client guidelines or the redefinition of the composite make it appropriate. The historical record of the portfolio must remain with the appropriate composite. If a firm sets a minimum asset level for portfolios to be included in one composite, no portfolios below the asset level can be included in that composite. Any changes to a composite specific minimum asset level are not permitted to be applied retroactively. So it's also important. Let's say I have one composite that is my 40% balanced for large clients. I have a bigger, more dedicated team for this composite. So this has minimum of $2 million. Or rather, this composite has a size or will consist of all portfolios with a minimum of $20 million or $2 million under management. If that is the case, then it should be clearly specified, and then you cannot change it retroactively. That is, in hindsight, you cannot remove that. Now I have made it $5 million. So all $2 million from the past also, or whatever portfolio was below $5 million, I will reduce. That you cannot do. It can only be applied proactively, and there should be documented changes if any such asset limit or minimum asset size limit you are changing. Firms that wish to remove portfolios from composites in cases of significant cash flows must define significant on an ex ante composite specific basis. So for each composite, what is considered a significant cash flow? So if there is more than $1 million in a particular portfolio, then I will move it from the small client to the large client composite. That has to be defined pre-hand for each composite, that when will some portfolio come into this composite and when will a portfolio go out of this composite. A composite, as you understood, is a collection of portfolios. For periods beginning on or after January 1, 2010, carve-outs must not be included in a composite unless the carve-out is actually managed separately with its own cash balance. So another very important concept, a lot of times from these balanced funds, that is 40% equity and 60% debt. So I have a balanced fund and I have an equity composite that has all equity portfolios. Now, theoretically, I can put the performance of this 40% part, I can measure separately and put it as a part of the equity composite. Now, this is not allowed unless this composite is managed separately and has its own cash balance. That is, let's assume this fund manager takes a 5% cash call. Then he's an equity fund manager, but at any point he's bearish, so he invested only 35% in the market. 5% was not invested. Then for the balanced fund for that period, the overall allocation would have been 35% and 65%. And if this 5% automatically went to the debt fund manager and he managed as though it was his fund, then this equity portion cannot be separated from this composite and cannot be put in the equity composite. Only if this 5% was separately kept aside as cash for this fund manager and was just put in a money market instrument or a simple instrument, then you can take it as any other equity portfolio and include it in the equity composite. Otherwise, you will not be allowed to create a carve out. To remove the effect of significant cash flows, firms should use temporary new accounts. So let's say I have an account that I'm managing. So let's say $100 million was invested and was being invested. Now suddenly $50 million came into this account. Now immediately I shouldn't increase the value of this 100 to 150 because I know I haven't invested that $50 million yet. So if I immediately make it $150 million, then that will just be incorrect because it will skew my return calculations. So what I should do is that I should create a temporary account of $50 million. And then as I have invested the $50 million, I can club it with my original account or account A, because it will be some time before the fund manager gets to know of the new cash flows and before he allocates it into the portfolio or incorporates it into the portfolio. So use temporary accounts for significant cash flows and include them in your account once they are invested or once they are a part of the portfolio. Once a firm, another important point, these are the required disclosures, so very important. Once a firm has met all requirements of the GIPS standards, the firm must disclose its compliance with the GIPS standards using one of the following compliance statements. So we studied this earlier also. XYZ claims compliance with the GIPS and has prepared and presented this report in compliance with the GIPS standards. The firm has not been independently verified. For firms that are verified, XYZ claims compliance with GIPS and has prepared and presented this report in compliance with the standards. XYZ has been independently verified for the periods so much to so much. The verification report is available upon request. So these are the two statements that you can use once you are claiming compliance with GIPS. Verification assesses whether the firm has complied with all the composite construction requirements of the GIPS standards on a firm-wide basis. Second, the firm's policies and procedures are designed to calculate and present performance in compliance with the JIP standards. Verification does not ensure the accuracy of any specific composite presentation. So the verifier for JIP's verification won't go down and verify every return or whether every NAV was calculated correctly or not. So if there is an error in that error still can be there even after verification. Verification just ensures that the composites have been created properly, that is similar portfolios have been clubbed together and all portfolios are present in one composite or the other. So the composite doesn't have a mix of unrelated portfolios, and that the policies and the processes in the firm are good enough or they are designed to calculate and present performance in compliance with JIPs. For composites of a verified firm that have also had a performance examination, wherein we've had somebody verify the performance figures also and the calculations have also been checked by some external party, the firm can claim the following, that is XYZ claims compliance with the JIP standards. XYZ claims compliance with the JIP standards and has prepared and presented this report in compliance with the JIP standards. XYZ has been independently verified for the periods. Verification assesses whether the firm has complied with all the composite construction of the JIP standards on a firm-wide basis, and the firm's processes and procedures are designed to calculate and present performance in compliance with the JIP standards. The XYZ composite has been examined for the periods for so many dates. The verification and examination reports are available upon request. Continuing with the disclosure requirements, these are very important now. Firms must disclose the definition of firm used to determine the total firm assets and firm-wide compliance. Firms must disclose the composite description. Firms must disclose the benchmark description. All of these are requirements, so you must remember them. So, definition of firm, description of composites, description of the benchmarks. When presenting gross of fees returns, firms must disclose if any other fees are deducted in addition to direct trading expenses. So gross of fees means only direct trading expenses are taken out. Net of fees is when you have taken investment management fees also, wherein also you must disclose that when you're doing net of fees returns, if any other fees in addition to the investment management and direct trading expenses has been deducted. If model or actual investment fees are used, and if returns are net of performance-based incentives. So estimated trading expenses are not allowed, but model investment fees may be used on an accrual basis. Firms must disclose the currency used to express the performance. Firms must disclose which measure of internal dispersion is used. Very important. So please understand what internal dispersion means. I may have many composites and I may have many portfolios amongst the composite. Now in every composite, we will give a overall average return as we calculated using the three methods: the beginning market value method, the beginning market value with cash flows, and the aggregate method. So wherein we presented a weighted average of the composites return. We are also required to present the internal dispersion. That is, let's assume there were 10 portfolios that made my composite. So I am required to present that the average of the composite may have come out to be 8%. But what was the standard deviation of these 10 portfolios? So various definitions for internal dispersion are allowed, but a measure for internal dispersion must be presented. Now, very common way of the institute to confuse you is present the standard deviation of the composites returns over history. That is not what internal dispersion is. Standard deviation of composite returns doesn't need to be presented. It may be recommended. You may present the standard deviation of your returns over past, but that is not required. What is required is that in that year, how did the different portfolios perform given the weighted average or given the overall composite performance? Firms must disclose the fee schedule appropriate to the compliant presentation, not complaint. Firms must disclose the composite creation date. So, very heavily tested this slide. They will give you a presentation performance and they'll ask you what is missing. So, in the disclosures, normally the date would be missing, definition of firm could be missing, description of the benchmark, description of the composite may not be there. The currency used, measure of internal dispersion, and as we'll see, other requirements must be or disclosed, or other disclosures are required. Firms must disclose that the firm's list of composite directions is available upon request. Firms must disclose that the firm's list of composite descriptions is available upon request. Firms must disclose that policies for valuing portfolios, calculating performance, and preparing compliant presentations are available upon request. Firms must disclose the presence, use, and extent of leverage, derivatives, and short positions if material, including a description of the frequency of use and the characteristics of the instruments sufficient enough to identify risks so that the client can know what kind of additional risks that are there in your portfolio because of any derivatives or short positions. Firms must disclose all significant events that would help a prospective client interpret the compliant presentation. For any performance presented periods prior to January 1, 2000 that does not comply with the GIPS standards, firms must disclose the periods of non-compliance. So that is allowed. Before January 1, 2000, you can present even periods or even performance that is not compliant. After that, it has to be compliant. If the firm is redefined, the firm must disclose the date of, description of, and the reason for the redefinition. If a composite is redefined, the firm must disclose the date of, description of, and the reason for the redefinition. Firm must disclose any changes to the name of the composite. Firms must disclose the minimum asset level, if any, below which portfolios are not included in a composite. Firms must also disclose any changes to the minimum asset level. Firms must disclose relevant details of the treatment of withholding tax on dividends, interest income, and capital gains, if material. Firms must also disclose if benchmark returns are net of withholding taxes if this information is not available, rather if this information is available. For periods beginning on or after January 1, 2011, firms must disclose and describe any known material differences in the exchange rates or valuation sources used among the portfolios within a composite and between the composite and the benchmark. For periods prior to January 1, 2011, firms must disclose and describe any known inconsistencies in the exchange rates used among the portfolios within a composite and between the composite and the benchmark. It's not very important. If there were inconsistencies, you should disclose that. If there were any differences in the exchange rates in the benchmark and in your portfolio, then you should disclose that as well. If the compliant presentation conforms with laws and regulations that conflict with the requirement of GIPS, then you must disclose this fact and the manner in which there is the conflict. For periods prior to January 1, 2010, if carve-outs are included, firms must disclose the policy used to allocate cash to the carve-outs. If a composite contains portfolios with bundled fees, firms must disclose the type of fees that are included in the bundled fee, that is direct trading expenses, some other research costs that you're availing from somebody, etc. So what is a part of the bundled fees? What kind of fees you must disclose? So prior to January 2010, firms must disclose if any portfolios were not valued at calendar month end or last business day of the month. We know that after this period, you're anyways mandated to value on the calendar end month or on the last business day of the month. For periods beginning January 1, 2011, Firms must disclose the use of subjective, unobservable inputs for valuing portfolio investments if the portfolio investments were valued using subjective, unobservable inputs and are material to the composite. So, a lot of times for valuing real estate, private equity, and other unlisted investments, we use subjective inputs. So, if we have used those, then they must be disclosed. For periods beginning January 1, 2011, firms must disclose if the composite's valuation hierarchy materially differs from the recommended hierarchy in the GIPS valuation principles. What this recommendation is, we'll see soon. If the fund determines no appropriate benchmark for the composite exists, the firm must disclose why no benchmark is presented. If the firm changes the benchmark, must disclose the date, description, and reason for the change. If a custom benchmark or a combination of multiple benchmarks are used, the firm must disclose the benchmark components, weights, and rebalancing process. If the firm has adopted a significant cash flow policy for a specific composite, then the firm must disclose how the firm defines the significant cash flow for the composite and for which periods. Firms must disclose if the 3-year annualized ex post standard deviation of the composite and or the benchmark is not presented because 36 monthly returns are not available. If the firm determines that the 3-year annualized ex post standard deviation is not relevant or appropriate, then the firm must describe why is it not relevant and describe the additional risk measure presented and why it was selected. So now we are not talking about internal dispersion. We are actually talking about the historical dispersion of returns that also needs to be presented. So 36-month return data or returns or 3-year annualized standard deviation needs to be presented. Firms must disclose if the performance from a past firm or affiliation is linked to the performance of the firm. So if we've just changed the definition of the firm and we are also using the previous firm's data because we are saying it was the same firm, it's just the name that has been changed, then we must disclose that any past firm's affiliation has been used in the presentation of the data. The recommendations on disclosures, again, not very important. The firm should disclose material changes to the valuation policies and methodologies, should disclose material changes to the calculation of the policies or methodologies, should disclose material differences between the benchmark and the composite's investment mandate, objective, or strategy, should disclose key assumptions used to value portfolio investments. If a parent company contains multiple defined firms, each firm within the parent company should disclose a list of other firms contained within the parent company. For periods prior to January 2011, firms should disclose the use of subjective, unobservable inputs for valuing the portfolio investments if the portfolio investments valued using the subjective, unobservable inputs are material to the composite. So a lot of portfolios did use these subjective valuations. After this, it is anyways a requirement. For periods prior to January 1, 2006, firms should disclose the use of a sub-advisor and the periods a sub-advisor was used. After this, anyways, it is a requirement. Firms should disclose if a composite contains proprietary assets. That is, assets that are managed for the firm's own shareholders. Again, these are recommendations. More important for you to remember the 35 odd requirements that were there as far as disclosures. So disclosure is definitely one of the most important sections of the GIPS standards, and a lot of questions on the exam based on when the disclosures were not appropriate and you were to identify what was the mistakes in the disclosures. Another important section is the GIPS presentation and reporting requirements. So the following items must be reported for each composite. At least 5 years of annual performance that meets the requirements of the GIPS standards. After presenting 5 years of performance, the firm must present additional annual performance up to a minimum of 10 years. Annual returns for all years clearly identified as gross or net of fees. For composites with a composite inception date beginning on or after 2011, when the initial period is less than a full year, firms must present the returns from the composite inception through the initial year end. So if the composite started in the beginning of the year, then you cannot, or rather did not start in the beginning of the year, then you cannot annualize the returns. If it was from March to December, then you will just present March to December returns and specify so. You are not allowed to annualize these returns. For composites with a termination date of January 2011 or later, returns from the last annual period through the termination date have to be presented. So if it started at the beginning but then terminated, so then from the last annual period till the termination date also the returns need to be presented. If it started in the beginning, likewise. No annualization basically can be done and the actual performance for those periods will be reported. Annual returns for a benchmark which reflects the mandate, objective and or strategy of the portfolio should be presented. The number of portfolios in the composite at each year end. If the composite contains 5 portfolios or less, the number of portfolios is not required. So it will be assumed that it has 5 or less portfolios. The amount of assets in the composite at the end of each annual period. Either total firm assets or composite assets as a percentage of firm assets at each annual year end must be presented. A measure of dispersion of individual portfolio returns for each annual period. If the composite contains 5 portfolios or less for the full year, a measure of internal dispersion is not required. So this is the internal dispersion that we talked about earlier. So this measure is definitely needed for composites that have more than 5 portfolios. For periods beginning on or after January 2011, firms must present for each annual period 3-year annualized ex post standard deviation using monthly returns for the composite and the benchmark. An additional 3-year ex post risk measurement if management feels standard deviation is inappropriate. The firm must match the periodicity of calculated returns used for the composite and the benchmark. So the benchmark is calculated daily, the portfolio must also be calculated daily. For computing the standard deviation, if for the benchmark we are using weekly returns, then even for our portfolio we should use weekly returns. Firms may link non-GIPS compliant returns to their compliant history so long as the firms meet the disclosure requirements for non-compliant performance, and only compliant returns are presented for periods after January 1, 2000. Returns of portfolios and composites for periods of less than 1 year must not be annualized. For periods beginning on or after January 1, 2006 and ending prior to January 2011, if a composite includes carve-outs, the presentation must include the percentage of the composite that is composed of carve-outs for each annual period. If a composite contains any non-fee paying portfolios, the firm must present as of the end of each annual period the percentage of the composite assets represented by the non-fee paying portfolios. If a composite includes bundled fee portfolios, the firm must present as at the end of each annual period the percentage of the composite assets represented by bundled fee portfolios. Performance track records of a past firm or affiliation must be linked or used to represent the historical record of the new or acquiring firm on a composite specific basis if substantially all the investment decision makers are employed by the new firm. That is the research department, portfolio managers and other relevant staff. The decision making process remains substantially intact and independent within the new firm. The new firm has records that document and support the reported performance. So if these are met, then even if you've acquired the firm, then you will represent the historical performance using the old firm's records if all these three criteria are met. If the firm acquires another firm or affiliation, the firm has 1 year to bring any non-compliant assets into compliance. So if I acquired another fund management company and I am GIPS compliant, but that other company is not GIPS compliant, then I have 1 year to bring that other company's performance presentation in the GIPS compliant manner. On the presentation and reporting recommendations, the firms should present gross of fees returns. The firms should present cumulative returns for composite and benchmarks for all periods, equal weighted mean and median returns for each composite, quarterly and monthly returns should also be presented. These are all recommendations now. These are not requirements. Annualized composite and benchmark returns for period greater than 12 months. For periods prior to January 1, 2011, the 3-year annualized ex-post standard deviation for the composite and its benchmark must be given. Rather, is recommended, it should be given rather than giving a reason for why it is not appropriate and giving some other measure. For each year in which an annualized standard deviation is present, corresponding annualized return should also be presented. For each year that an annualized composite and benchmark returns are reported, the corresponding standard deviation of monthly returns for the composite and benchmark should also be given. So this is the full year's performance, but how is the performance varying over the months? Additional ex-post composite risk measures should be given. Firms should present more than 10 years of annual performance in the compliant presentation. Firms should comply with the GIPS for all historical periods. Firms should update compliant presentations quarterly. So these are recommendations, not very important. The reporting requirements, however, are very, very important and are very often tested on the exam. So we'll do some questions before we move on to the real estate requirements. Account 510 invests in illiquid fixed income securities. The account receives a large cash infusion on March 12 that cannot be invested quickly at a reasonable prices. It is expected to take 60 days for the funds to be reasonably invested, or even 40-50% of the funds to be invested. So what should you do? Place the funds in a temporary new sub-account until the funds are invested. So continue to report the results for 510, the original account, in the appropriate composite. Returns for 510A will not be reported in any composite. Once 510A is invested in accord with the account objectives, 510A will be merged into 510 and will affect future results of 510. Alternative solution is that the firms could be placed directly into 510 and then the returns would be excluded from the composite until the funds are invested in accordance with the client objectives. GIPS composite returns or results are based on monthly results. So if investments are completed by May 15, account 510 will be excluded for the composite for the months April, May and June. So this alternative solution is only allowed for portfolios that have received as a large external cash flow. That is only for a small period of time they get allowed to be excluded from the composite's return calculation. Otherwise, we've discussed in the past, all portfolios or all discretionary portfolios have to be included in the composite's return calculation. You cannot pick and choose which portfolios you will keep or which you won't keep, but only if a portfolio has a large external cash flow, then for a temporary period of time until you invest those cash flows, you're allowed to exclude it. The better solution would be the first solution, definitely, wherein you keep a temporary account wherein you keep these cash flows separate and you keep the regular 510 account going as it was. And once you've substantially invested, you combine the portfolios and start reporting the combined performance. Nero Asset Management manages portfolios that include 4 styles: international equity, fixed income, balanced, that include all the 3 balanced portfolios that include all the three segments. Nero maintains composites for each of the four investment styles. Within Nero, there are separate teams that manage each of the three asset segments. One of the accounts, the RJ Foundation, is a balanced account that has a strategic objective to invest 1/3 in each of the three asset segments. RJF results are reported as a part of the balanced composite, and Nero would also like to report the domestic equity results as a part of the domestic equity composite. He will only be allowed to do this if the equity composite was managed separately with a separate cash balance. Nero should set up an account for RJF and manage it as a separate account. If, for example, RJF is a $60 million portfolio, then $20 million should be placed in domestic equity account, and the performance of this separate sub-account can be included in the domestic equity composite. The results of the entire 60 million RJF must continue to be included in the balanced composite. So each portfolio must always be a part of at least one composite. In cases like this, it can be a part of two composites also. So RJF's equity is being a part of the equity composite, and RJF's equity is also being a part of the balanced fund and the balanced composite. The following figure illustrates the structure of a composite during 2012. An X indicates that the portfolio was included in the composite for the quarter. If a cell is blank, the portfolio was not included in the composite for the entire quarter. Determine which portfolios should be contained in the internal dispersion measure of 2012. So please understand, internal dispersion is the standard deviation amongst these 6 portfolios. That is, if the average return of the composite was so much, then the individual portfolios have deviated how much? Now, we can include only those portfolios for whom the annualized return was available, as we are not allowed to simulate, or we are not allowed to annualize performances for less than 1 year. So only portfolios A, C and E can be included for the internal dispersion calculation, or you can calculate the standard deviation only amongst these portfolios for which the returns were available. So we'll now go through the specific requirements for performance of, or reporting the performance of real estate. So beginning January 1, 2011, real estate investments must be valued in accordance with the definition of fair value and the GIPS valuation principles that we will see. For periods prior to January 1, 2008, real estate investments must be valued at the market value at least once every 12 months. For periods beginning January 1, 2008, real estate investments must be valued at least quarterly. For periods on or after January 1, 2010, the firm must value portfolios as of the end of each quarter or the last business day of each quarter using fair value principles. We'll see what these principles and what these valuation guidelines are. So remember, prior to 2008, once every 12 months. From 2008, 2010, every quarter. And after 2010, every quarter on the last business day of each quarter. For periods prior to January 1, 2012, real estate investments must have an external valuation done at least once every 3 years. External valuation means an outside independent party certifies to perform such valuations, or certified to perform such valuations is what should be used. For beginning 2012, real estate investments must have an external valuation done at least once every 3 years. For periods prior to January 1, 2012, real estate must have an external valuation done at least once every 3 years. External valuation should be done by an outside independent party who is certified to perform such valuations. For periods beginning January 1, 2012, real estate investments must have an external valuation done at least once every 12 months. Beginning January 1, 2006, real estate portfolio returns must be calculated at least quarterly after the deduction of transaction costs during the period, that is whatever brokerage etc. costs have been spent. Beginning 2011, income and capital component returns must be calculated separately using geometrically linked time-weighted rates of return. Composite returns, including component returns, must be calculated at least quarterly by asset weighting the individual portfolio returns using time-weighted rates of return. The firm must provide a description of discretion. Discretion in real estate exists if the firm has sole or sufficient discretion to make major decisions regarding these investments. Often the firm won't. Often the client will direct a lot of the real estate investments. The firm must disclose the internal valuation models used and the frequency of external valuation. Beginning January 1, 2011, disclose material changes in valuation approach and differences in internal and external valuation and the reason for the difference. On or after January 1, 2006, GIPS compliant and non-compliant performance may not be linked. Prior to this date, any such linking must be disclosed. In addition to the total return, the capital return and the income return components must be disclosed, must sum to the total return, and must be clearly identified as gross or net of fees. May present total return and component returns gross of fees, net of fees, or both ways. For any quarterly return, the income and capital return components must sum to the total return. If the firm calculates monthly returns, the monthly component returns will sum to the monthly total return. The quarterly return is found by geometrically linking the monthly returns. Composites with more than 5 portfolios must disclose the high and low of the portfolio time-weighted rates of return as the internal dispersion measure. So the highest of the portfolios and the lowest return should be presented. The percentage of composite assets valued using an external valuator as of the end of each annual period. So what percentage were valued externally?